If someone handed you $100 today and asked you to turn it into $1 million, most people would immediately think they need a brilliant business idea, a lucky investment, or a huge salary. But what if I told you that's not how most millionaires actually build wealth? In reality, the biggest difference between people who stay broke and people who quietly become wealthy isn't intelligence, luck, or even income. It's understanding how money actually works. And the surprising part is that once you understand the system, you'll never look at your paycheck, your bank account, or even your spending habits the same way again. Think about this for a second. Every single day, millions of people wake up, go to work, earn money, pay bills, buy things they need, buy plenty of things they don't need, wait for the next paycheck, and then repeat the exact same cycle for decades. Some earn $30,000 a year, others earn $300,000. Yet many of them still feel financially stressed. If making more money automatically made people rich, every doctor, lawyer, athlete, and celebrity would stay wealthy forever. But we know that's simply not true. Every year, we hear stories about lottery winners going bankrupt, professional athletes losing fortunes, and high-income families living paycheck to paycheck. So if income isn't the answer, what is? To understand that, we first need to understand what money really is. Most people think money is wealth. It isn't. Money is simply a tool. Imagine you're playing a video game. In that game, coins help you buy better equipment, unlock new abilities, and progress to higher levels. The coins themselves aren't the goal. They're just a resource that helps you move forward. Real life works exactly the same way. Money is simply a resource that gives you choices. The more wisely you use it, the more freedom you create. The more carelessly you use it, the more trapped you become. Now here's where things get interesting. Let's meet two people. Jake and Ryan are both 25 years old. They work at the same company. They earn the exact same salary. They receive the exact same paycheck every 2 weeks. From the outside, their lives look almost identical. But one small decision completely changes their future. On payday, Jake checks his bank account and immediately starts thinking about what he wants to buy. Maybe it's new clothes, a nicer phone, eating out more often, or upgrading his car. None of these purchases seem expensive on their own. They're just little rewards after working hard all week. Ryan also checks his bank account on payday, but before he spends a single dollar, something different happens. 10% of his paycheck automatically moves into a savings and investment account. He never sees that money sitting in his checking account, so he never feels tempted to spend it. Whatever remains is what he lives on. At first glance, this difference seems tiny. Jake spends first and saves whatever is left over. Ryan saves first and spends whatever is left over. The amount is exactly the same, but the order completely changes the outcome. This is one of the oldest principles in personal finance, and it's called paying yourself first. It sounds simple because it is simple, but simple doesn't mean easy. Most people spend first because their brain naturally focuses on immediate rewards. Buying something new feels good today. Saving money doesn't feel exciting because the reward comes years later. Your brain loves instant gratification. It hates delayed gratification. That's why almost everyone says they'll start saving next month, after the next raise, after paying off one more bill, or after life becomes less expensive. But somehow that perfect moment never arrives. There's always another expense, another holiday, another emergency, another sale, another reason to wait. Years pass, income grows, spending grows even faster, and savings never really catch up. This is called lifestyle inflation. Every time your income increases, your lifestyle quietly expands to match it. A bigger apartment, a newer car, better restaurants, more subscriptions, nicer vacations. None of these purchases feel unreasonable individually, but together they silently consume every raise you ever receive. That's why someone earning $100,000 can feel just as broke as someone earning $40,000. The problem isn't always income. The problem is that expenses grow every time income grows. Ryan avoids this trap with one simple rule. Every raise he gets automatically increases his savings first. If he receives a $500 monthly raise, maybe $300 goes directly into investing before he even has the chance to spend it. His lifestyle improves slowly, but his future improves much faster. Jake does the opposite. Every raise becomes an excuse to spend more. After a few years, both men earn significantly more than when they started. But Ryan's investments are growing while Jake's expenses have exploded. Here's the fascinating part. During the first year, their financial lives don't look very different. During the second year, the gap is still small. But by year 5, something incredible begins to happen. Ryan isn't just saving money anymore. His money is beginning to work for him. And that's where the real transformation begins. Because once your money starts earning money, you're no longer relying only on your paycheck to build wealth. You're building a financial system that keeps growing even while you sleep, and that's exactly what we'll explore next. Ryan's biggest advantage isn't that he earns more money. It's that he understands one simple idea that Jake completely overlooks. Every dollar can either be spent once or put to work forever. Imagine hiring an employee who never sleeps, never asks for a raise, never takes a vacation, and works 24 hours a day, 7 days a week for the rest of your life. That sounds impossible, but that's exactly what investing does. Every dollar you invest becomes a tiny worker whose only job is to make more money. At first, those workers don't accomplish much. They earn a few dollars here and there, almost so little that it feels pointless. This is the stage where most people quit because they mistake slow progress for no progress. But investing doesn't reward impatience. It rewards consistency. Think of it like planting a tree. During the first year, the tree barely grows. You water it, take care of it, and protect it, but from a distance, it almost looks exactly the same. The second year isn't dramatically different either. If you judged the tree after only 24 months, you'd probably conclude it wasn't worth the effort. But 5 years later, it's providing shade. 10 years later, it's producing fruit. 20 years later, it's something you couldn't replace overnight, no matter how much money you had. Wealth works exactly the same way. The early years feel slow because you're building the foundation. Once that foundation becomes large enough, growth begins accelerating almost on its own. This is something Albert Einstein supposedly referred to as the 8th wonder of the world, compound growth. Whether or not he actually said it, the principle itself is very real. Compound growth simply means that your money begins earning money, and then the money it earns begins earning even more money. Imagine you invest $100. Over time, it grows to $110. Now you're no longer earning returns on $100. You're earning returns on $110. Eventually, that becomes $120, then $130, then $150. Years later, you're no longer contributing most of the growth yourself. Your investments are doing much of the work. That's the moment everything starts to change. Unfortunately, most people never reach that stage because they interrupt the process. Every time the market drops, they panic and sell. Every time they hear about someone getting rich overnight through cryptocurrency, meme stocks, or some new investment trend, they abandon their long-term plan in search of quick money. Human psychology is often the biggest obstacle to building wealth. Our brains evolved to respond quickly to danger, but the stock market rewards people who stay calm when everyone else is panicking. Imagine planting a seed, then digging it up every week to check whether it's growing. That's exactly what many investors do when they constantly check their portfolio, react emotionally to every headline, and change strategies every few months. Great investing is often less about finding the perfect investment and more about avoiding bad decisions. Now let's go back to Jake. He finally decides he wants to start investing too. But instead of building a habit, he starts chasing excitement. One week he buys shares in a company because someone on social media says it's the next big thing. The following month he sells because the price falls. Then he buys cryptocurrency after hearing a friend doubled their money. A few weeks later it crashes, so he sells again. Jake believes investing is about constantly making the right prediction. Ryan sees it differently. Ryan understands that nobody consistently predicts the future. Instead of trying to guess which company will become the next giant, he invests steadily every single month into diversified investments. Whether prices are high or low, he continues buying. When prices fall, he isn't scared. He's actually buying the same investments at a discount. While Jake sees falling prices as bad news, Ryan sees them as a sale. Imagine walking into your favorite store and seeing everything marked down by 30%. Most people would be excited. But in investing, people often react in the opposite way. They become afraid when prices fall, even though they're getting the exact same assets for less money. That's because emotion usually overrides logic. Successful investors learn to separate the two. They build systems instead of relying on feelings. Ryan doesn't ask himself every month whether he feels like investing. The money leaves his account automatically. By removing the decision, he removes the temptation to procrastinate. Another mistake many people make is believing they need a lot of money before they can begin. They imagine investing is only for people with thousands of dollars sitting in the bank. But the most valuable thing you can invest isn't your first $1,000. It's your first habit. Someone investing $50 every week for 20 years often ends up in a much stronger position than someone who waits 10 years hoping to invest larger amounts later. Time is often more valuable than the amount itself. Every year you delay isn't just another year without investing. It's another year your future money loses the opportunity to compound. This is why financial success usually looks boring from the outside. There are no dramatic headlines, no overnight millionaire stories, no secret tricks. It's simply thousands of ordinary decisions repeated over and over again. Save first, invest consistently, ignore the noise, repeat next month. The people who quietly build wealth rarely look extraordinary in the beginning. In fact, for several years they often look exactly like everyone else. The difference only becomes obvious much later, when the power of time finally catches up with the power of habit. And that's where the biggest lesson of all begins, because wealth isn't just about having more money. It's about buying something much more valuable than money itself: freedom. And that's exactly where our story goes next. We left off with one powerful idea. Wealth isn't really about having more money. It's about buying freedom. And once you understand that, you stop looking at money the way most people do. Most people think money exists to buy things. Wealthy people understand that money exists to buy time. Think about it. Why do people dream about financial freedom? It isn't because they want a bigger number in their bank account. It's because they want choices. They want the freedom to leave a job they hate, the freedom to spend more time with family, the freedom to travel without worrying about every dollar, the freedom to handle an emergency without losing sleep. In other words, money itself isn't the goal. Freedom is. Money is simply the tool that helps you get there. Let's go back to Jake and Ryan one last time. 20 years have now passed. They both worked hard. They both received promotions. They both experienced recessions, inflation, rising housing costs, and unexpected emergencies. Neither one had a perfect financial journey, but when they reached their mid-40s, their lives looked completely different. Jake earned good money throughout his career, but every raise brought a larger lifestyle. He upgraded apartments, financed newer cars, bought expensive electronics, and slowly increased his monthly expenses. None of these decisions seemed dangerous on their own. In fact, each one felt completely normal. Everyone around him was doing the same thing. Every purchase was justified by the fact that he was earning more than ever before. Yet somehow he still felt like he was waiting for the day he would finally get ahead financially. Every month, his paycheck arrived already spoken for. Mortgage, car payment, insurance, credit cards, streaming services, groceries, utilities. There was always enough to survive, but rarely enough to feel secure. Ryan experienced the exact same economy, but he followed one rule for 2 decades. Every paycheck paid his future first. Every raise increased his savings before it increased his lifestyle. Every investment happened automatically, whether the market was going up or down. During market crashes, he kept buying. During bull markets, he kept buying. During economic uncertainty, he kept buying. He didn't try to predict the future because he knew he couldn't. Instead, he trusted the process. This is one of the biggest differences between successful investors and everyone else. Most people spend their time trying to predict what the market will do next. They ask whether it's the right time to invest. They wait for prices to fall. Then when prices finally fall, they're too afraid to buy because every news headline predicts disaster. Ironically, the best opportunities often appear when confidence is at its lowest. Imagine walking into a supermarket and seeing every item discounted by 50%. Most people would fill their shopping carts. But when investments go on sale because the market drops, many people run in the opposite direction. Fear changes the way we think. We assume falling prices mean danger, even when history has shown that markets have repeatedly recovered over the long term. Ryan understands something Jake never fully learns. Temporary declines are a normal part of investing. Panic is optional. This doesn't mean investing is risk-free. Every investment carries some level of uncertainty. But there's another risk people rarely talk about, the risk of never investing at all. Inflation quietly reduces the purchasing power of money every year. Imagine hiding cash under your mattress for 30 years. The number of dollars would stay exactly the same, but what those dollars could actually buy would shrink. That's why simply saving money isn't enough over the long run. Savings protect you in the short term. Investments help protect your future over the long term. Another lesson Ryan learned is that financial success has very little to do with looking successful. Social media has convinced people that wealth looks like luxury cars, designer watches, expensive vacations, and giant houses. But appearances can be incredibly misleading. Many people who look wealthy are simply financing an expensive lifestyle with debt. Meanwhile, some of the wealthiest people you will ever meet drive ordinary cars, live in comfortable but modest homes, and rarely try to impress anyone. They understand that every dollar spent trying to look rich is a dollar that can no longer grow into real wealth. Think of wealth like an iceberg. The part everyone sees is the lifestyle, the expensive clothes, the car, the vacations. But the largest part of the iceberg sits below the surface where nobody can see it. That's the emergency fund, the retirement accounts, the investments, the paid-off debts, the assets quietly producing more income year after year. Real wealth is often invisible. One of the biggest mindset shifts you can make is to stop asking, "Can I afford this?" and start asking, "What is this purchase costing my future?" Those are two completely different questions. Maybe you can technically afford a new luxury car payment. But what if that monthly payment invested over 20 years could have become hundreds of thousands of dollars? Every financial decision has an opportunity cost. Every dollar spent today is a dollar that can't compound tomorrow.
That doesn't mean you should never enjoy your money. Building wealth isn't about living a miserable life or saying no to everything that makes you happy. It's about spending intentionally instead of emotionally. Buy the things that genuinely improve your life. Cut the things that only impress other people. Spend on experiences you truly value. Eliminate spending that exists only because of habit, advertising, or social pressure. The goal isn't to spend less forever. The goal is to spend smarter. If you remember only one thing from this video, remember this: your financial future is rarely decided by one huge decision. It isn't determined by one perfect investment or one lucky opportunity. It's built by hundreds of ordinary decisions that seem almost insignificant in the moment. Every payday, you choose whether your future gets paid first or last. Every raise, you choose whether your lifestyle grows faster than your investments. Every purchase, you choose between immediate satisfaction and long-term freedom. The beautiful thing about money habits is that you don't have to be perfect. You don't need to invest thousands of dollars every month. You don't need to understand every stock, every economic report, or every financial headline. You simply need a system you can follow consistently. Save first, build an emergency fund, invest regularly, ignore the noise, repeat month after month. year after year. Because here's the truth that almost nobody tells you. Becoming wealthy usually feels incredibly ordinary while it's happening. There isn't one magical day when you suddenly feel rich. Instead, you slowly notice that financial stress disappears. You stop worrying about surprise expenses. You stop checking your bank account before buying groceries. You stop feeling trapped by every paycheck. One day, you realize you have something far more valuable than money. You have options. That's what financial freedom really is. It's the ability to make decisions based on what you want instead of what you can barely afford. It's knowing that your money is working even while you're sleeping. It's understanding that every paycheck isn't just paying today's bills, it's building tomorrow's opportunities. So the next time payday arrives, don't ask yourself what's left after you've spent everything else. Ask yourself a better question. How much am I paying my future today? Because that one simple habit, repeated over years instead of days, is what quietly separates people who stay trapped in the paycheck cycle from those who eventually achieve financial freedom. And in the end, wealth isn't built by earning more than everyone else. It's built by consistently keeping more of what you earn and giving your money enough time to work harder than you ever could. That's the money habit that truly changes everything.